Hi, everyone. I'm Mike Basita with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. This month's video update is going to be a good one, as we'll be hearing, as always, from Andrew Beer, co-founder of DBI and co-portfolio manager of DBMF. He'll be touching on some macro items, the competitive landscape, performance, positioning, etc., but the emphasis will be mostly on two specific topics that are both compelling and groundbreaking, respectively. I don't want to give any spoilers here, so with that, let's get right to it, Andrew. I'm going to hand it off here to you.
Thanks, Mike. So we were up around 0.3% in August on a price basis, with both equities and bonds down a decent amount. As importantly, we're about 70 basis points ahead of the SocGen CTA index, here and after the quote hedge fund index, unquote, which, as you all know, is an index of 20 leading managed futures hedge funds. During the third quarter so far, DBMF is outperforming the index by around 150 basis points, making back some of the ground we gave up early this year, and after we outperformed by around 300 basis points net last year. On the mutual fund and ETF side, the Morningstar US Trend Systematic category, here and after the quote Morningstar category, unquote, lost about 80 basis points last month, a bit worse than the hedge funds. Note that the Morningstar category also underperformed those hedge funds by around 600 basis points last year, which explains why we decided to try to replicate what the real hedge funds are doing. On the macro front, it's safe to say that confusion reigns supreme. The economy just isn't supposed to be this resilient in the face of 500 basis points of Fed rate hikes. And maybe it's because there's pent-up savings, or your brilliant neighbor locked in a 30-year mortgage at 3% and is perfectly happy to stay put, or the government keeps spending more money like there's no tomorrow. Anyway, that's the Teflon economy. Or maybe the shockwave is coming, but it hasn't hit yet, a delayed boom. And when it does, it'll be a doozy. Zombie companies finally get shot. Commercial real estate goes poof. Consumption plummets. Or maybe we skate through in some modern-day Goldilocks scenario, the theme du jour. Taken together, we have three very different paths in front of us: higher for longer, a quick taper and a return to the go-go 2010s, or something much worse where inflation reaccelerates like in the 1970s. And as consensus keeps slipping back and forth, markets keep oscillating, and it definitely has not been a wonderful environment for trend followers. Not disastrous, more like 2 steps forward and 2 steps back. Of course, after 2022, I think we need to give these guys a bit of rope. By the way, on the macro front, we do have 2 slides that I'll show you in a sec that we think are worth maybe printing up and putting on a wall somewhere. But before we leave this slide, let's talk about our positioning. We are long the euro and short the yen, which you can think of as a bet that the EU will keep raising rates, but damn it all, Japan will not. This has been our one profitable asset class this year, in large part because the yen is down something like 13%. Recall the yen also was our most profitable position last year. And while other markets keep oscillating, the intransigence of the Japanese monetary authorities has been a gift to trend followers. So a funny historical note, trend following in currencies was essentially dead money for years. And in 2020, an allocator asked us to build a trend follower with no exposure to the asset class. So we refused under the theory that dormant markets can suddenly become very trendy. So we would caution anyone trying to predict which markets from a trend perspective will be most valuable over the coming few years. It really does seem that diversification across all asset classes just appears to work better over time. So moving on, we're short treasuries. So we're well positioned if inflation rises again from here. That's the topic of one of the upcoming charts. We're also modestly long equities, short gold, and long crude oil. Overall, I'd say that in the short term, we're positioned for higher for longer on the inflation front. Of course, please remember that the portfolio is dynamic, so you should read these positions as reflecting current market sentiment, not a long-term forecast. So to keep this moving, let's jump to the next slide. So we have 2 special slides this month. This one shows the long-term correlation of the S&P 500 and Treasury yields, courtesy of Refinitiv. When it's above 0, bonds are a good hedge against equities. When it's below, they're moving up and down together. So most of you grew up in a world where the hedge was working. And now welcome to a generational shift, as coined recently by the Wall Street Journal. The hedge ain't working anymore. This is DEFCON 5 for $5 trillion of model portfolios, the cornerstone of which is how combining the 2 major asset classes can give clients a smoother ride. And if that line stays below 0, a 60-40 portfolio will be a scary roller coaster ride over the coming decade. And clients do not want to be put on scary roller coasters. Further, most diversifiers, which are linked either to stocks and bonds, won't help much. Hence, we think every allocator out there should drop everything And look for diversifiers that have no correlation to either stocks and bonds. And if you've already bought into a strategy like managed futures, then you might want to materially increase your allocation. The asset allocators of 2030, armed with data from the 2020s and trying to build nice optimized models, are likely to want a 10% or higher allocation to managed futures, and we suggest you get in front of that wave. Next slide, please. This chart compares the path of inflation in the 1970s to today. The blue line is the nightmare of the 1970s. The Fed thought that it had squashed inflation, relaxed its grip, and then it came roaring back, helped, of course, by OPEC. The orange line is today. Battle-hardened economists like to point to this chart to make two arguments. First, don't be complacent that inflation is dead yet. Second, no one at the Fed wants to be the guy who made that mistake in the 1970s. They don't expect the Fed to start cutting until it's crystal clear that the beast is tamed. The smart money these days seems to think that rates will remain high, which happens to be when stock and bonds correlations tend to be positive, like the past 18 months, like August, and that this will ripple through the markets for years. So maybe not a single violent shockwave, but rather a series of rolling crises like SVB in March. Next slide, please. So that was my great windup as to why managed futures should be a strategic allocation in your portfolios along stocks and bonds over the coming decade. Eric McArdle of Simplify, our competitor but kindred spirit in our belief that managed futures should be an essential part of every portfolio, coined a very, very good metaphor that managed futures anchors the third leg of the asset allocations tool. Most diversifiers are simply shoring up one leg or the other, which isn't likely to stabilize much going forward. Hence, with managed futures, you've one of the few low or zero correlation hedge fund strategies you can actually deliver to a mutual fund or ETF. So, the largest brand name hedge funds, are alpha generation machines and often have zero correlation to anything. But you have to pay 10% a year. You have to type your money for a decade, and you need to be able to write a $100 million check to get them to answer the phone. So with that preamble, here's our performance since inception versus the S&P 500 and Bloomberg Ag. Since launch in 2019, we've delivered between 9% and 10% per annum of alpha relative to the S&P 500. And DBMF has returned 45% cumulatively when bonds have lost money. So it really shouldn't be a question of whether a strategy like this goes into a diversified portfolio, but rather how much. And next slide, please. Okay. As the guys who replicate hedge funds, of course, we need to talk about how we're doing relative to them. Here's our chart with performance versus the hedge fund index and Morningstar category. The punchline is that DBMF has outperformed both since inception with a correlation of around 0.9. As I think everyone listening to this will know by now, we are simply trying to deliver as much of the pre-fee performance of the space as possible, but with lower fees and very low trading costs. Hence, we think replication is potentially a way to consistently outperform both hedge funds and mutual funds, not through more clever modeling or esoteric instruments, but by identifying the core exposures of leading hedge funds and mimicking them with deep, liquid futures contracts. And if you haven't seen it, you might want to Google a paper we just published in Institutional Investor. The title is something like, "Is managed futures the perfect asset class for replication?" We showed data, and the next slide is going to be eye-opening, but we also provide a framework. In essence, managed futures hedge funds and mutual funds build wave detectors. They point them at the market C, zooming in on 70 or more individual futures contracts. At any point in time, some will be going up, some will be going down, and some won't be doing much. But the fairly obvious point is that waves move in clusters. Many instruments are inextricably linked to each other. Does anyone seriously think that 10-year and 30-year Treasury contracts will move in completely different directions over the next 10 years? Or that natural gas would decline during a commodity supercycle? Of course not. And futures only move up and down. So what replication really does is to identify the clusters as determined by the wave detectors, then simply invest in the deepest and most liquid futures contracts within that cluster. It turns out that the clusters drive alpha generation, not some 2% position in some esoteric, thinly traded contract. And this has two great potential benefits. It's much more efficient than buying and selling individual waves. And there's no risk of market crowding, which means we are happy for you to see our positions every day in a transparent ETF. Next slide, please. So the only people who really question whether replication can and should work are people who build and run highly profitable wave detectors, and this is understandable. A few decades ago, this was an esoteric and exclusive strategy where they could charge people 10 points a year for the privilege of investing. Today, hedge funds might make 3%, and the average mutual fund is down is around 1%, according to data from Bloomberg and Morningstar, respectively. So not low, but lower. And all this is because the space has been on a long and winding path to commoditization. 30 years ago, only a handful of people knew how to build these things. The data was hard to get. Derivatives like futures contracts were arcane. You had to know how to program. Fast forward to today, and some retail investors post their own models on Twitter. X. So commoditization is not great for managers, but a terrific thing for allocators. And replication is another brick on that road. So sometimes practitioners feel the need to toss a grenade or two in our direction. The most common grenade or criticism of replication is that the portfolio is too simple. In DBMF, we use only 10 core factors to replicate portfolios, which might have, on average, 70 futures contracts. And that gets us to a correlation of around 0.9 over time. So to end this discussion once and for all, we decided to show what a replication of the SocGen CTA hedge fund index would look like using only 4 futures contracts: the 10-year Treasury, crude oil, Euro, and S&P 500. One big contract per asset class. We aimed the replicator at the estimated pre-fee returns of the space by simplistically adding back a 1% management fee and 20% performance fee. So in the chart, the bottom line is the performance of the index. The orange line above it is the estimated pre-fee returns, and the black line on top is replication. Over 15 years, the blindingly simple replication model would have essentially matched the pre-fee performance of the 20 leading managed futures hedge funds in the index, with a correlation around 0.8 and shallower drawdowns, all with the same diversification benefits to both stocks and bonds. So mind you, the drawdown of this simple 4-factor model would have been much shallower than that of the index, which completely destroys the argument that fewer positions is somehow riskier. So to follow the metaphor, as a general rule, we think an allocator should want the clusters cheaply, not the individual waves expensively. So we encourage you to look up the article, and if you want to read a bit more, about the analysis and conclusions. And by the way, if you ever want to see what a replication of a single manager mutual fund or ETF looks like, call us. It is quite illuminating. Next slide, please. Finally, here's our standard chart on volatility-adjusted positioning. As a reminder, we show volatility-adjusted positioning since it could be confusing when looking at notional position sizes. What looks like a big position in something like the 2-year Treasury might be less risky than a small position in crude oil. So this helps to make the exposures more apples to apples. This month, we're also showing it relative to June 30 to underscore how dynamic the portfolio has been over the summer. To start from the left, we flipped from short to long crude oil and from long to short gold. We've increased our long position in the euro, but cut back a bit of the short in the yen. We're short across the Treasury curve, whereas after the SVB unwinds, we had flipped for a period to long the 10-year. And lastly, we're modestly long equities and unwound a spread trade that the S&P 500 would outperform non-US developed stocks at EM. And with that, I'll hand the baton back to Mike.
Excellent. Thanks, Andrew. So our closing slide tells the ongoing story of how successful this strategy has been, very simply, showcasing the since inception performance of DBMF versus the index, which we seek to plus replicate by reducing most of the fee drag while eliminating excess complexity via the ETF's efficient construction. It also contrasts DBMF's performance against the category average as defined by Morningstar. You'll see here that the long-term performance, which is what we focus on as long-term allocators and investors, against the index has broadened since our last update, beating the SocGen CTA index by over 200 basis points annualized since inception. Outperformance against the Morningstar average has also expanded, over 395 basis points annualized since inception. We believe these results are convincing, and we hope you do too. The combination of index plus replication, with fee reduction being the purest form of alpha, are the key characteristics of what makes DBMF so unique and so compelling. So closing here by saying thanks to all of our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. iMGP.com. Until next time, from DBI and from iMGP, thanks for spending time with us.